it's okay. So, I think we should start. Okay, so I think we should start now for the parallel session. Okay. So for this first parallel session, we have devoted to systemic risk, geopolitical risk, and stress test. We have four papers, sorry. And the first paper is a paper of Giovanna Nicodano. So I give you the floor now. So you have 20 minutes, and then Elena Dimitrescu will introduce the discussion after the second paper. Okay? Thank you.
Good afternoon, and merci. And let me thank the organizers for having this paper in the program. And may I have my slides showing? Thank you. This is joint work with Luca Regis, who is also at the University of Torino and Collegio Carlo Alberto. And in this paper, we are going to study the relationship between optimal leverage and short-term risk-free interest rates in a specific setting, which is the setting of complex organizations. In the typical models of capital structure, you study what we call a standalone company, i.e. a company which is composed just by one unit. But this is not the case in several situations, such as consider a private equity, where there is a fund that backs up a portfolio of companies. So that is one example of complex organization. There are also similar structures in securitization arrangements, where you have a bank and the special purpose vehicles. And of course, there are also bank holding companies with the parent company with several subsidiaries, and the same is for business groups with the same structure. To keep things simple, we think of all the subsidiaries being consolidated in just one unit, which we call the backed unit. And let me see. Okay. So what do we study is the relationship between leverage and interest rates in a trade-off model. Why the choice of a trade-off model? Because there is, while it is still debated whether the trade-off model applies empirically in the data to standalone companies, there is ample evidence that complex organizations offset the default costs implicit in higher leverage with the benefits deriving from lower taxes, what we call the tax shield. And so there is this, also in the data, we see that complex organizations increase debt at higher spreads when interest rates fall. Okay? So we ask whether this is consistent with the trade-off theory, and the answer is no. Several models predict a monotonic relationship. Why is that the case? Because as interest rates fall, the spread falls, and so does the tax shield. So what we do is we extend the trade-off theory to complex organizations and ask how they will behave as interest rates vary. And the key comparison that we will have is between the standalone units that are endowed with stochastic cash flow and parameters characterizing the taxes, the proportional default costs, and correlation coefficients among the cash flows. And this is the benchmark case, and we will compare it to a sponsor and a backed unit. And when we do the comparison, we will set the parameters in the sponsor equal to the one of one standalone, and similarly for the backed unit. And what characterizes our complex organization is the fact that the sponsor may support a backed unit. When is this the case? When the backed unit is insolvent, when the sponsor has enough cash flow to bail it out, and the backed unit also has positive cash flows. Why? Because otherwise it would not incur any bankruptcy cost, any default cost. So why bailing it out in the first place? So just to be a little bit, just to anticipate the results, what we will see is that under regularity conditions, under normal, like reasonable parameters, what we see is we recover in the standalone case, which is modeled after a model by Hein Leland, we see that indeed optimal debt, default costs, etc., all drop when interest rates fall. On the similar result will apply to the sponsor unit that will actually delever completely, becomes zero leverage after a certain interest rate cutoff. Below that interest rate cutoff, we will see that the backed unit increases leverage. And we will see numerical results that the increase may really be dramatic. And so will also default costs and, importantly, the tax shield. And the effects will be stronger the higher the correlation between the cash flow of the sponsor and the cash flow of the backed unit. So the overall result is that there is a heterogeneous response of optimal debt to interest rates, both within the organization, because the sponsor decreases or at most keeps it constant, while the backed unit increases the leverage, and across different organizations. And lower rates not only act on the level, but also on the reallocation of leverage within the complex organization. Please stop me if a clarification is needed. So what's the relationship with the literature? Quickly, we connect three different literatures. The one on trade-off capital structure models that has expanded in the direction of becoming dynamic. We have a static model, but we expand it in the direction of organizational complexity. And similarly, the complex organization models that belong to two different strands of literature, the one on the internal capital markets and the one of organizational design, typically do not address the issue of optimal capital structure of these complex organizations, and let alone their changes with interest rates. And we also relate to papers outside corporate finance, namely papers regarding the transmission of monetary policy. And the cash flow-based theory of monetary policy already envisaged the possibility that when interest rates fall, borrowing increases. Why? Because the service of debt becomes less costly. What we add to this literature is a separate tax shield channel. So briefly, the setup, as I mentioned, we compare two standalone companies modeled as in Leland with a sponsor-backed organization that is modeled after a paper, our previous paper in the RFS. And each unit issues a zero coupon debt with face value F, and that maximizes total value, equity plus the value of debt. And it can be shown that this is equivalent to minimizing the expected taxes plus expected default costs. Cash flows will be realized in the future at some pre-specified time in the future. And as I mentioned before, the only difference between the standalone and the complex organization is that the backed unit receives support, this contingent support from the sponsor, and also that the maximization is concerned. So how am I doing with time? Yes. I don't know whether to look at the formulas, but maybe I skip the formulas, and if needed, I will go back later. And that the maximization is for the overall value of the complex organization, not just one unit at a time. So why is it the optimal debt of the standalone shrinks with lower interest rates? In our results, it shrinks not only because the tax shield falls. Lower interest means lower deductions from taxes, and so lower tax shield. So the benefit of debt falls, but we were surprised, but also because of that reason, at fixed level of debt, we see that the default costs increase. Why is it? Because lower tax shield means lower net operating profit, and so a higher possibility that they won't be able to pay back the debt. So both because of the tax shield and because of the default costs, the optimal debt is lower in the standalone. Instead, in the sponsor, we have that it can not only lower debt, but also reach a threshold such that it does no longer lever up. And why is it the case? Because the sponsor considers not only its own tax shield when considering the benefits, but also the tax shield of the backed unit. That if it receives more backing when it is insolvent, it can lever up more. And so if the interest rate falls enough, it will specialize in providing support to the backed unit. But why is it that the backed unit can lever up so much? Well, on the one hand, it has support. It expects support, so it can lever up more, but also it receives support only in positive cash flow state. That means that it will go bankrupt mostly when lenders do not recover anything. And so, but the lenders know this. It's not a moral hazard model, so they charge higher spreads. And those higher spreads lead to a higher tax shield. So it's critically based on this contingent support mechanism that make the tax shield of the backed unit more interesting. So some numerical results that use the same parameters as Leland paper. And in particular, the parameters are equal across all the units. And so the red is the standalone benchmark. The blue is sponsor-backed unit. And as you can see, you don't see it, but, but I can tell you that in this parametric case, whichever the interest rate that is on the horizontal axis and falls from 5 to 1, the sponsor is optimally zero leverage. So in this case, the complex organization reminds of a private equity fund that has zero leverage, and the backed unit could be a portfolio company. And what you see is that already at the 5% interest rate, the backed unit that has all the complex organization debt on its shoulders has already a debt which is twice as large as the one of the standalone. Notwithstanding, when interest rates fall, debt increases, so the highly levered backed unit increases borrowing, which reaches like almost more than 4 times the level of debt of the backed unit. And the same occurs for default costs and for tax savings that increase together with debt. Now, what are we seeing here is just a snapshot of the 5-year default probability of the loss given default and of the spread. And again, we see this divergence between the result for standalone companies and for the backed unit. And by the way, since the backed unit increases leverage and the sponsor is zero leverage, in this numerical case, it's the complex organization that has higher leverage than the 2 standalone benchmark. So it's not only the case that the backed unit increases leverage, but since the sponsor has constant leverage, it's the overall complex organization that is highly levered. Now, what you see here instead is the more general case where initially the sponsor has an incentive to borrow, contrary to the private equity case I was depicting before. How do we make this positive leverage in the sponsor? We simply raise its tax rate to the level that we set in the previous paper, the previous published paper. And so you see exactly what is the proposition, the key proposition of the paper is saying, that as the interest rate falls, initially you see a similar behavior for the debt in the complex organization and in the standalone benchmark. The blue line runs parallel the red line. But at the cutoff interest rate, which is 3, the divergence obtains. So it's a non-monotonic relationship in the general case. And again, similar results for tax savings, default costs, etc. This picture is a little bit more complex to read, but it essentially identifies each unit at a time. In green, you see the backed unit. In red, the sponsor unit. And the gray and yellow lines are respectively the standalone with the parameters of the sponsor and the standalone with the parameters of the backed unit. And as you can see, the sponsor becomes very safe, while the backed unit becomes very unsafe. So risk, to talk about hidden risks, risk is hidden in the backed unit. And joint default risk is, however, very low, because essentially the sponsor only closes down when it has negative cash flows. So the implications for empirical research are several, since this session has papers interested in credit risk. Well, low-rate environments may concentrate risk in backed entities, even when sponsors appear safe. Then the default probability skyrockets in the backed unit, maybe too much because we do not have countervailing covenants or something like that, but still the message is that. But there is also an interesting aspect, and I'm talking to the people interested in systemic risk. It is not the case that it's only riskier, because the risk of the, say, the private equity kind of organization moves in opposite direction with respect to the risk of the standalone units. And so there may be some smoothing in that. And for default prediction and leverage regressions, we should be careful in accounting for the possibility of these shifts in sign. And just the takeaway is that we think that capital structure research should move from the one unit observation to encompassing the ownership and structure of this complex organization. Thank you very much.
Okay, good afternoon. Thank you for being here. My name is Eugene Chen. I'm a student from CEPR Paris. Today I will present our paper, Joint Backtest for Systemic Risk Measure. And this is a joint work with Professor Simon Benoit from Dauphine and Professor Jeremy Lemery from Clermont. Let's start with some motivations. So systemic risk measures are designed to summarize a financial institution's contribution to systemic risk in a single number. And then they help rank institutions by systemic importance, especially when the market is under distress. So in this paper, we will focus on systemic risk measures computed with time series market data. That means they are market-based. For example, we will focus on marginal expense shortfall, MES, conditional value at risk, core, and the deal core. So we need to do the backtest on the risk measures. Backtest meaning that we compare the ex-post outcomes with the ex-ante forecast. For the usual risk measure like war, the backtesting is very practical. But for systemic risk measures, it is a little bit harder because the objects are multidimensional and conditional. So the previous paper in 2021 firstly proposed unconditional coverage and independent backtest for MES-based measures. And in 2024, Fischer and Hoge, they found that the standalone systemic risk measures are not identifiable by themselves. So if we want a proper backtest, we need to jointly backtest the systemic risk measure with the market war, which rely on the strict joint identifications. So here comes our paper. So our paper makes 3 contributions. The first one is that we propose a strict joint backtest for war MES, war core, and Dale core. The second one is that our backtest is fully forecast-based. That means that we use only reported forecasts and realized returns. We do not require the full predicted distributions. Third, we also do the robust inference under the estimation risk, and we do it for 3 estimation schemes: fixed, rolling, and expanding. So now let's come to the framework and introduce some definitions. So first, we have that YIT means the institution returns, YMT means the market return. And then we define that the war is the alpha quantile of the market return distributions. And then we can use this war to define the market distress event. That means the market return is below this war. And MES is the conditional expectation. It means it's the expected return of one financial institutions under conditional of the market distress. And then move to the core. Here we use the exposure core. That means this core is the beta quantile of the institution return with same conditional on the market distress. And also the Dale core just the difference between 2 cores. One is in the stress state, another one is in the mania state. And then in practice, we don't actually observe the theoretical object. We observe the model-based forecast. Right here, I use VMT to stand for the forecasting market war. MUIT stands for the forecast MES of one financial institution I, and similarly, CIT stands for the forecast core. And we also need to define some simple hit indicators. Right here, IT means the market distress indicators. So when it equals 1, that means the market return is lower than the forecasted market war right here. And the JT is similar, is the institution core's hit indicators. And for the Dale core, we also need to define the ITM and JTM for the median state. Because MES is the conditional expectation, so for MES, we simply use UT to stand for its forecast error. And under correct specification, there are 3 calibration conditions that should be held. For the first one, that means the market distress should happen with probability of alpha. And for the core one, that means the institution's core hit indicator should happen with the probability of beta. And then the similar logic works for the delta core, for the median state. And for the MES, so same, because MES is conditional expectation, so its calibration condition right here means the forecast error has a conditional mean 0, based on the still same, based on the market distress. So here, let's move to what we are exactly testing. So we are exactly testing the strict joint identification vectors for any one of the 3 measures. We use mu to stand for the MES, C stand for the core, and the delta stand for the delta core. So for war MES, our identity factor has 2 components. The first component is just the market war calibration conditions, and the second one is for the core. That means we check this. The second one is for the MES. That means that we check these MES are calibrated or not. So similar logic for work for the war and the core. The first component is still the market war calibration condition. The second one is we check whether these institutions' condition quantile are correctly calibrated or not. So for Dale core, that will be a 4 times 1 vector. So that's the 4-dimensional case. The first 2 are for the stress core, and the last 2 are for the median core. So, I mean, these 4-dimensional structures are very useful because if our backtest rejects, we need to figure out where the problem comes from. It might come from the stress state. It may also come from the mania state, or both. And then, so the null hypothesis we would like to test is actually a conditional one. That means for any one of the or three systemic reminders, or null hypothesis is that the identification vector GT has a conditional mean zero. That means or GT is a martingale difference sequence. And actually, this information set is whole information set is a functional restriction. So we need to convert it to an unconditional one. So we follow the 2006 paper. We multiply our identification vector by the ft-1 measurable instrument ht to define our instrumented moment mt. And right now, under our null hypothesis, this mt has unconditional mean zero. So that said, firstly, we try to test our forecast is correct given past information. Now we only test the moments can be averaged to zero. And the choice of our instrument HT can determine what kind of test we would like to run. So if the HT is just the identity matrix, then we will get an unconditional test. If the instrument HT collects liked conditional variables, then it will be a conditional test. A special case is that if those liked variables are liked identification terms, this will be an independent test. So independent test is a special case of the conditional test in our framework. So we have the very unified framework right here. And then we go to the inference part. So still for one of the three measures, let's define some part firstly. So we define this capital M is the in-sample estimation window, and the capital N means the auto-sample backtesting window. So we aggregate the moments over the backtesting window and scale them by the square root n. Then we get these sample moments. And we prove that under the null hypothesis, our sample moments are asymptotically Gaussian. And with the covariance matrix, let me move quickly. And this is the key result of ours. I mean, our covariance matrix has a very simple decomposition. You may look like the notation may be complicated, but the intuition are very simple. So it has three pieces. The first one is the non-parameter covariance, and it will reduce to the variance of the moments under null hypothesis. The second term is the closed term. So it captures the covariance between the moment noise and the parameter estimation noise. The third term is the pure estimation risk term. So it just captures the variance of the parameter estimation noise. And we have these two kappa parameters. They are scheme-specific weights. Scheme-specific weights means that they only depend on the estimation scheme and only depend on the sample ratio. Right here I use P to stand for the sample ratio. And when P goes to 0, this kappa goes to 0, and the correct term vanishes. And here is when we have our consistent estimator, we plug in and we construct this statistics, and then we prove that it is asymptotically chi-square. And in practice, we provide two versions of PET test. The first one is the standard test. So on the standard test, we use only the sigma j, that means the non-parameter covariance matrix. That means we ignore the estimation risk. And the robust version means that we do the estimation risk correction, and we use the fully corrected covariance omega j right here. Let's see some multicolor studies. So we consider two DGP right here. One is marginal, that means they use the static barrier Gaussian. Another one is conditional, is the dynamic GGR-DCC model. If you are not familiar with the model, that's okay. I can show you some figures right here. So right here, we start with the estimation windows, and then we move to the backtesting windows. So black line right here is the simulated market return, and the orange line right here is the market war. We can see that this market return with very time-varying volatilities, so that the market war is also time-varying. And the red dots right here are market distress events. This for the market side. And for the institution side, the black line right here are simulated institution returns, and the orange lines are stress core, and the vertical red line are the market distress days from last figure. And I also mark the red dots right here means the drawn distress hits. So back to our empirical setup, we use the tail level 5% and 50% the conditional level right here. Why use the 50% right here? Because we try to see more observations of the drawn hit. So it may be not usual in the practice, but right here we use it to see more simulations. And still, we backtest 3 measures. We consider uncontrolled test and controlled test based on different instruments, and we consider standard and robust tests. That means we consider the estimation risk or not. And then we reported the size under correct specification and size adjusted power and the misspecification. I will go through it very quickly. We can skip this table. We can directly see the figures right here. So right here, we have 3 measures. We have the conditional DPP, marginal DPP, plus conditional or uncontrolled test. And we consider 2 sample size combinations. The first one is the estimation window is the shorter than the backtesting window. Right here, the sample ratio P equal 2. We can see that the red point means the standard test. The blue triangle means the robust test. We can see for the standard test, it has very large size distortions. It overdrag very lot. And for the robust one, that means we correct estimation risks. You can see that the vertical dashed line, that means the 5% nominal level. We can see that after the correction, the overall rejection frequency back to the 5% nominal level. And then for another sample size, when the sample ratio equal to 0.5, that means the reverse case, we can see that both tests improve that, and the distortion is not that big, actually. And we can also see that for the conditional DGP, it seems harder than the marginal DGP, and it works for any one of the 3 measures. And I will quickly show the power result. So we have 4 types of the misspecification. The first one means that we understated the institution size scale. And the second one means that we understated the market size scale. The third one, A3, means that we shrinkage the correlations. And B4 is we use the static forecast, even though the true DGP is dynamic. And we also have the 3 level, the severity levels. Right here, I only show the size adjusted power under conditional DGP or unconditional test, robust version, and with the same sample size. We can quickly see the figures right here. So we can see for our A2 setting, it seems the easiest misspecification to detect. And you can see our tests have very high power for each one of the 3 measures. And A3 comes with the next one, and the MES seems the strongest one. And then it's the A1, still MES is the strongest one. But for the B4 case, we can see that the overall performance is weaker, but the Dale cohort is the strongest one. So let's give a quick conclusion. So we developed the strict drawn forecast-based backtest for VAR and MES, VAR cohort and Dale cohort, and we do the robust inference under estimation risk. So we found out that ignoring estimation risk will lead to over-rejection, and our robust VAR tests stay much closer to nominal size, and our empirical application is ongoing. Thanks so much.
Yes, the first set of slides, please. Okay. So thank you for the opportunity to discuss these 2 papers. It was, well, they are completely different, but there is one point which rejoins them, which is the systemic risk. So concerning The first paper, it shows the impact of a lowering of the risk-free rate on the capital structure and implicitly on the default rate in the case of complex organizations. And the authors find that there is an asymmetric leverage response, which in the end entails a risk, a hidden risk, which goes through the backed unit, and this is where this underlying systemic risk can be found. So the contribution of the paper in 2 words is in showing precisely that complex organizations behave differently than standalones, and that you have these 2 mechanisms that are at work, and that in this case, the monetary conditions are going to amplify all this and generate systemic risk and fragility. A short comparison of the 2 cases, the standalone benchmark where lower rates will lead in the end to the traditional trade-off theory, as it was mentioned, whereas in the case of complex organizations, we have an increase in default risk. So the main conclusion is that policymakers should actually try to regulate organizations overall and not just look at the standalone firms, the firms by themselves. So my comments are from, let's say, an econometrician side. So they are mostly either some, let's say, curiosity or elements, or some questions related to possible extensions of the paper. I'm not sure everything is doable, but let's go ahead. First, we know that monetary policy can affect not only the discounting, but also demand, productivity, and so forth. So what would change if your cash flow would be rate dependent? A linear or non-linear relationship, as you wish. What happens if you think you take a more realistic setup where the agent have some forward-looking expectations? So you would say that after a long period of low rates, there's a normalization, but if this normalization is in steps and it's somehow anticipated and not just a one shot, what changes to your framework? Third, what about risk-averse investors, meaning that you move from a Gaussian distribution to something with fatter tails? And what about going from a one-period guarantee to multi-period guarantees? Also, that may change your results and make things more realistic. And two more comments in the same line. How does your mechanism change if there were multiple backed units? Because you focused, you said that it's important to look at the organization, but considering just 2 firms in the organization may be a bit simplistic from this point of view. So what would change in this case? Would there be more heterogeneity? And if there is heterogeneity, how would the sponsor choose which of the backed units to support more or less, or everything for one and nothing for the others? No idea. And how should the regulator react in the end to your findings with respect to the backed units? Should there be some capital surcharges for them? How would that impact your results if you were to include them somehow in your model? So would that impact the low rate amplification? there's an empty. Okay, so thank you. That's my first discussion. We can move to the second one. Okay, so for the second discussion, I'll proceed similarly. First, with a small summary, saying that, of course, regulators need sound systemic risk backtests, but we know that it's not obvious. I don't know, there are researches in this direction for at least about 10 years. We know that COVAR, co-expected shortfall MES, are neither identifiable nor elicitable standalone, but there are some, let's say, intermediate results that have restored identifiability on one side when we take pairs, and at the same time, there is this recent paper by Fissler and Hoga, which introduces multi-objective elicitability. So the paper is going to rely on these two strands of the literature, and the more common one in this setup, which is that of estimation risk, which remains a major challenge, and try to propose, in the end, a unified strict identification function framework, which is able to backtest systemic risk measures, existing systemic risk measures. It's a fully model-free backtesting. That's one of the main advantages, in the sense that in the end, you only need the returns, which are observed, and the risk forecasts, irrespective of the model that is used to obtain them. Okay, so that's a major advancement in the literature, because it doesn't require predictive distribution, re-estimation, nothing else. The other contribution, as I already said, it's that there is an explicit estimation risk correction, because again, even for simple backtests of value at risk, this has engendered quite some literature saying that the main testing methods need to be robust to this issue. So implementing this in the case of systemic risk, it's something as important, and it's nice to see that there are ways to deal with this issue. And the third point is this unified treatment of delta COVAR, which is very innovative, and relies into this decomposition into the stressed and median components, and hence a four-dimensional identification system. So I'll come back to this in my questions. So my main comments are precisely on this point, on the orthogonality conditions, because I think the user and the reader needs more insight into how this works, and which is the contribution, for example, of each of the two strict identification functions for COVAR. Let's say take a realistic simulation example, and for example, consider that in the data generating process, that the first condition holds, but not the second one, and try to see which are the implication, and you know, distinguish a bit the role of each of the two conditions. To complement this, what about the interpretation of moment conditions? Because the user, again, might want to understand a bit better why stress versus median. How do you define the median part? Is this you took 25% and to 75% of the distribution. how robust your results are to this choice, so discuss a bit this part. More realistic GDPs. I think this is an important issue because you consider a Gaussian distribution with GJR-DCC framework, but we are on financial data and we know that tails matter a lot. So how would a distribution which takes into account some of these features would change your results. On the positioning of the framework, I think it's also important to say a bit earlier that your contribution is with respect to this absolute evaluation framework, so what we generally call backtest in the literature, which complements the results of Fisla and Hosler, and Hoga, sorry, which propose a comparison test. It's not the same type of approach, and I'm not sure it's completely clear when you start reading the paper. And another clarification point about the computational cost, because it's quite involved, everything that you do, so I'm curious about how much time it takes, and is it feasible, for example, if you have a large panel of firms. For the estimation window, in Fisler and Hoga, from 4,000 observations, actually you only get to use 200 when you look at distress events. We know regulators ask in general a set of 250 observations, but how many do you actually have in the tails? And you know, it's quite a difficult task to handle this, so it would be interesting to focus a bit more on it. And similarly, would rolling versus expanding window change something to your results? And finally here, for the multi-horizon forecast, would the power of the test change and the estimation risk with the horizon length? You could do some extensions, like on other measures, but of course not necessarily in the same paper. And on multivariate systemic risk here, would the identification be possible in these higher dimensions, and what would that imply? And finally, again, sort of a robustness test, given that you can use whatever model you want to do the forecasts. Nowadays, we know that machine learning forecasts are quite competitive, so maybe that would be an alternative for one of the simulation setups you consider. So that's about it. I hope we gain some time.
Thank you, Elena. You did a great job. You had two very different papers, and you gave very nice ideas. Now, we are challenging the model and trying to understand whether it can replicate private equity metrics under more reasonable parameterization. And for instance, we are taking into consideration the fact that it can improve productivity, and what we find is that it does a good job in matching the changes when interest rates change, but it's too much leverage, which is also a problem, a known problem of trade-off models. So the idea of imposing risk aversion and considering the different the rates expectations rather than a one-shot change would definitely work towards lowering this excess leverage, be it in the standalone or in the private equity across interest rates scenario. And I do not talk about regulation in this paper. We spoke a little bit in a prior paper about it, but in this one we stop there because in order to regulate properly with capital surcharges or we should identify the R bar, which is also a moving target. And so otherwise, if you put too much capital surcharge when R is above R bar, you're actually impeding the work of support, which reduces default costs relative to the standalone benchmark. So you have to be very careful in regulation. Cash flows state dependent because monetary policy affects several things. What really matters in this case is the relative size of cash flows to the standalone versus cash flows to the backed, because it affects the possibility of support, it affects the tax incentives in the sponsor relative to those of the backed unit, and results may shift, at least. Like they remain in the same flavor, but they may shift. And last but not least, the 100 million questions, what about more than 2 units? I think we are now in a situation where network models capture higher order complexity, several units, but are relatively black boxy. Here we deal with just 2 units explicitly, and I would love to have some high sky mathematicians being able to generalize. Thank you.
Thanks so much, Professor. I mean, for the computational course, this is a very sad question. So, you see, in the first version of our draft, we use the word model-free, but actually, only our standard test is model-free. You can see that. But for our robust test, that means we correct the estimation risks. We use the decomposition of the covariance matrix. There are many parameters inside, right? There are varied parameters, there are sensitive parameters, and they need to be estimated. So that's where the computational cost comes from. So I will say something. I mean, I remember that for 250 sample sizes, it computes like 200 computing hours. I mean, that's really a lot. It costs a lot of my money. But our standard test, that's purely model-free. Of course, we ignore the estimation risks, but I think that is an okay version, similar like the UC or independent test for the backtesting VAR, right? So, I mean, for the standard version, that's okay. But for the robust version, it is computationally cost, and it needs further modification maybe. And you also mentioned that the machine learning based one. So we already did that part. We already consider some machine learning right now is very popular. So we already consider some machine learning enhanced system risk measures. Like machine learning has the core, or machine learning has the MES. And we backtest them using our standard test, and it works. But I didn't show the result right here. But thanks so much for everything.
So congratulations to all the presentators and the discutant. Congratulations to you, and it was his first academic presentation. So congratulations, Johan. And it's time for to go to the second part of the session. So with the paper of Yuan and Nguyen.
So good afternoon, everyone. So let me begin by say thank you to the conference organizer for giving me the opportunity to present my joint work with my colleagues from Le Mans University, Frédéric Carmé, and Tao Nguyen from the Catholic University brand. So in this paper, we are interested in assessing the vulnerability and the contagion risk in the mutual funds industry, and we have worked on a sample of the US domestic equity mutual funds. So, as we all know, mutual funds have become, during the last decades, the biggest player in the financial system, and what happened to mutual funds can have a substantial impact on the financial stability of the whole system. So that's why understanding and assessing the vulnerability in isolation of mutual funds, as well as the potential of mutual funds to separate the risk among them and maybe to other financial intermediary to the whole economy is not trivial. And in this paper, we try to address these concerns. So traditionally, mutual funds, the open-end mutual funds are considered to be immune to bank run line risk, as they operate with flexible daily net asset value. They are already regulated, strictly regulated. They use low level of leverage, even no leverage at all. So that's why we used to think that they are free of bank run line risk. However, we know that mutual funds promise daily redemption while engaging in, maybe with this graphic can help me to explain better. However, mutual funds promise daily redemption while engaging in illiquid assets. The liquidity transformation of mutual funds, how can I say, is based on the assumption that liquidity transformation is costless and liquidity provisions are borne by redeeming investors. Yet, in practice, we also know that asset liquidation to meet a redemption demand typically occur one day or the day after the redemption ask. So the costs of the liquidity transformation are not borne by redeeming investors, but by remaining investors. So this mechanism creates a kind of first mover advantage and have a given incentive to investors to redeem early. This strategic complementarity, consequently, this strategic complementarity, sorry, this mechanism make mutual funds fairly exposed to bank run line risk because of the inherent liquidity mismatch, and the first mover advantage exacerbate mutual funds fragility, and that's why it's very important for us as researchers and policymakers to assess, to quantify their vulnerability as well as the contagion risk. So why the domestic equity mutual funds? When it comes to the US, we can see that the domestic equity mutual funds represent around half of the assets managed by the US mutual funds, so it's a very important subsector. But despite the economic importance of this subsector of mutual funds, studies on the vulnerability of mutual funds have focused rather on money market funds, bond funds, as they are considered more vulnerable to liquidity risks. So in this study, we would like to bridge the gap in this study. So what we try to demonstrate in this study is the fact that although domestic equity mutual funds at first sight invest in domestic equity, so they have a very similar exposures, similar styles, but when we look in details, we know that they represent different, important differences, still difference in risk exposure, difference in liquidity, difference in investor base, and these differences can make some kind of fund, some styles of fund more vulnerable than others. So in this study, we like to work at the style level and not at the aggregate level. We hope that our result will contribute to the ongoing debate on how to regulate mutual funds with systemic risk. We have recently some advanced in regulatory framework, but actually it operates with a one-size-fits-all framework. And we are convinced that it is not effective, and you'll see why. To address these issues, we try to answer to 4 questions. The first one is how vulnerable are major equity fund style to market shocks? How does their vulnerability evolve across different type crises, how they propagate shocks across styles, and which style transmits stress, which absorbs stress. We'll show that there is a strong heterogeneity in style vulnerability and contagion roles, with growth and mid-cap are main transmitters, while micro-cap is the main absorber. And the sector remain highly integrated even in car market, and that's why we advocate at the end that we need a style level monitoring instead of a one-size-fits-all framework. Our study is naturally built on 3 strands of literature. The first one is theoretical work, which shows that there exists inherent structural liquidity mismatch in mutual funds that render them vulnerable to liquidity, vulnerable to shock. The second one is more empirical work that deal with the assessment of vulnerability level of mutual funds. But as far as we know, there are more work on bond mutual funds for the reason that I mentioned earlier, that they are considered as more vulnerable than equity funds. And recently there have been a lot of work that deal with the whole system macroprudential tests that include banks, mutual funds, insurers. The closest work to our is Frick 2021 that work on the same sample as ours, but over a shorter period. The second one is the work of Lee that deals with Luxembourg mutual funds, and another study of Irish central banks that cover a sample of Irish mutual funds. The third literature is about the use of spin-over approach to measure the contagion analysis of different financial markets. So we extend the work of these studies to adapt this work to some characteristic of our funds that I will develop later. Our contribution here are twofold. The first one is methodological, because in the first part, in the first exercises, we've done a vulnerability analysis in which we extend the work of FIC and FIC 2021 by incorporating more granular data that take into account funds sensitivity to the shock via not only the asset holdings but also the sensitivity of the stocks in their portfolio. In the second place, we model the sensitivity of investors to bad performance of fund when the shock happens by introducing a two-regime markup switching model with two state of market, normal and stress. And the third contribution in this exercise is to introduce fire sale effects by taking into account the time-varying asset-specific liquidity ratio. In the second exercise and the second empirical exercise, we enhance the spin-over approach, Dearborn and EMAS, but we estimate according to the method, barring in order to obtain stable estimation in highly correlated systems. So as far as we know, we are the first study that combine this framework to measure mutual fund systeminess. Quickly about our data, we work on the period of January 2003 to December 2023, which include the subprime crisis and the COVID-19. All our data come from the CISP mutual fund database and the CISP stock file for US domestic equities. We work on the most popular styles of mutual funds, which are growth income, large cap, mid cap, small cap, and micro cap, which provide us a sample with more than 9,000 individual funds and more than 20,000 individual stocks. So in the first exercises, we base our measures on the framework developed by Greenland 2015, which was built to assess the vulnerability of banks. So FIC and FIC adapt this framework to take into account the specificity of mutual funds. So as a FIC and FIC, we simulate a market drop of 5%, a three-level fund average, 0, 1/3, and the max of the rise. So in response to the shock, of course, we will measure the capital loss of the funds, which is function of the asset holding in the portfolio, the sensitivity of this asset to the shock, which is not considered in the work of FIC and FIC. As to the run dynamics, we measure investor outflow, the sensitivity of investors in the two states of the market, normal and stress, while in the work of FIC and FIC, there is only one fixed flow performance for own funds. Regarding the fire sale effects, as I said earlier, we introduced stock level time varying price impacts. We can see on the work that we need to compute in order to calculate the loss that we call aggregate vulnerability for each fund, and then we aggregate this vulnerability into fund style, for each fund level, style level. So this graphic gives you an idea about what we obtain for 3 levels of leverage and to state the market, normal versus stress. As you can see that generally funds are resilient in trunking period, except for the period of subprime. We see the peak. We observe here about a loss of ranging from 0.5% to the highest level of 8%. Why we didn't observe any impacts of the COVID-19 on the fund vulnerability. And without surprise, we also document substantial impacts of leverage that can render funds 10 or even 16 times more vulnerable than without leverage. And the most vulnerable style are growth-oriented styles. The most resilient are microcap and small cap, which make us to recommend regulation that should target growth-oriented styles with stricter buffers. In the second exercise, so let me go very quickly. The idea of the approach that we use here is that in this part we need only fund returns. We have 6 styles. Yeah, we have six styles of daily returns that we combine in 6 series of returns, and from 6 series of return we estimate vector autoprogressive in order to measure the connectedness, the interconnectedness of the system. We can see from the total connectedness index. We can measure the directional connectedness, which the level of interaction between different styles, and lastly, the net directional connectedness, which helps us to identify the most systemically important institution. So I'll skip this detailed table. Here you can see that for the 2 subperiods, we observe a very high level of linkage between these styles. The total connectedness index is always higher than 80%, meaning that shock to any style can propagate rapidly across the system, and which is not surprising because we know that these styles invest only in domestic equity mutual funds and with important overlapping portfolios. The second result is also intriguing, is the fact that we observe some changes in systemic role over the first period, which cover the endogenous financial shock, the subprime crisis. Transmitters are growth, mid-cap, large cap, while receivers are growth income, micro-cap, small cap. When we go to the second sub-period with the endogenous COVID-19 shock, with the environment of low interest rate and the rise of passive investing, transmitters are now mid-cap, growth income, both small cap, while receivers are micro-cap and large cap. So to summarize, we can see that our vulnerability in contagion shows that there is a strong heterogeneity in style vulnerability in contagion role, with growth and mid-cap are main transmitter and micro-cap is the main absorber. So in terms of policy implication, we would recommend style level monitoring instead of one-size-fits-all regulation, and with a target focus on strategy like growth or growth income, general growth-oriented styles with more important liquidity buffers. We can also imagine swing pricing, which can be allowed for some vulnerable style to internalize the redemption externalities in order to limit the first mover advantages, so reduce the vulnerability of these funds. And the last one we can say is that size-based metrics are not sufficient. One fund, or one big fund doesn't mean that is not necessarily the most resilient. For example, large cap was the main transmitter in 2008, became a receiver of shock after that. So we are wondering if we need to use a network topology to identify transmission hubs. And that's all. Thank you very much.
Okay, so good afternoon, everyone. Thank you for being here. Today, I will present a joint work with my co-authors Guillaume Flamand, Christophe Hurlin, and Quentin Lajonie. So let me do first a broader introduction and context. I will try to be quick on this because Jacoviello and the first one table already did a good job doing it. But just to emphasize the need of stress testing, we can remember the last December press release of the ECB, where they first stressed the increase of the geopolitical context and the need for reverse stress testing framework and stress testing framework to assess the geopolitical risk. So, our article brings together two strands of literature. The first one is obviously measuring geopolitical risk, and the cornerstone paper is the one from Cadara and Jacoviello in 2022, where they provide a systematic way to proxy the geopolitical tensions. This is a well-used index in academia by practitioner and also by the supervisor. So it had, another good points to using when we are working in a supervisory framework such as stress testing. The second strand of literature is the one on stress testing and credit risk. Stress testing provides the natural framework to assess bank vulnerability. A good paper that describe the modern stress testing framework is the one from Henry and Koch 2013, where first stress testing rely on macro scenarios and are then plugged into what is called credit satellite model. Because in this paper we will focus on the probability of default, the traditional way to do, to link the macro-financial conditions to the probability of default is to rely on the Merton-Vasicek model. So the research question is, how does a geopolitical shock translate into portfolio risk, default risk? So to highlight our contribution, let me first emphasize the standard approach. So first, standard approach rely on exogenous macro scenarios. Stress testing team do not have access to the model that generate those scenarios. Typically, this is done by a macroeconomic team in the banks or given by the regulator when it's the annual exercise. After that, they rely on reduced form macro to credit links, such as the Merton-Vasicek model. And sometimes they rely heavily on simulation. While in another part, our framework provides a non-endogenous macro-financial shock propagation, a structural mapping from the macro conditions to the probability of defaults. And because we have those two first blocks, we can propagate the uncertainty from the generation of the macro scenarios into the credit risk parameter. And we do all of this with a closed form PD responses, which allow us to not rely on simulation. Okay, so now let me dive into the details of the methodology. So in our methodology, there is 2 steps. The first step can be decomposed into 2 blocks. So there is first a macroeconomic block, and the second block of the step 1 is the credit satellite block. The step 2 is where our contribution really lie. This is the step 2 that will create a bridge between the 2 first blocks. We will compute impulse responses to a geopolitical shock and propagate them through the nonlinear Merton mapping. I emphasize the nonlinear Merton mapping to obtain portfolio PD responses. Okay, so step 1, first block, the macroeconomic block. So we chose to model the joint dynamics of the geopolitical risk using Gaussian Bayesian VAR, which is classic in the macrofinancial literature. And we also use a classic Bayesian specification, which is an inverse Wishart prior on the covariance matrix. And then, because we have a conjugate prior, we obtain that the stacking of the vector coefficients follow conditional on this matrix, on this valence covariance matrix, follow a Gaussian distribution with the following parameters. So, and I think if you remember well, this is also the same specification used in the paper from Caldera and Iacoviello, where they assess the shock of the geopolitical risk on the macrofinancial condition. Okay, so now the step 2 is the credit risk block. So this is the classic formula from Merton-Vasicek. On the left of this equation, this is the point-in-time probability of default. And on the right of the equation, we have PE, which is the long-run average PD, and the factor rho, which is the sensitivity of the PDs to the systemic macrofactor. The only quantity that we do not observe, that we do not have, is the latent systemic factor. Okay? The point-in-time probability of default can be estimated by just the observed default rate. The long-run average PD can, be computed using the average of those observed default rates. And the rho parameters are, in practice, given by the regulator, given the fact that we are on a retail portfolio or on a corporate portfolio. So the only quantity missing is the latent systemic factor. So we want to calculate it by inverting the Merton formula and to link it to macrofinancial variables. Okay? Because the aim of the latent systemic factor is to link the point-in-time probability of default to the macrofinancial conditions. So here in practice, in a bank, they estimate it using classic linear regression. And here we took only a subset of the VAR, and we did not take the GPR as an explainable variable. Because in practice, if we want to implement it into a bank, they already estimated all their satellite equations. So we do not want to touch what they did. So in practice, we will only need to estimate the Bayesian VAR to do our stress testing exercise. Okay. So the step 2. Let me recall what we want to study. We want to study the effect of a one standard deviation into the innovation of the geopolitical risk index. And our object of interest is this quantity here. So this is the generalized IREF in the sense of Kopp, Pesaron, and Potter in 1996. And so we need to be able to compute those two expectations, and it's not clear that we can obtain a closed form to calculate those expectations. Okay, so this is the object of interest. But first, the shock comes from the macroeconomic block. So we should first compute the response of the macro-financial system using, as I said, generalized IRF. And this generalized IRF for the Bayesian VAR is easy to compute because this is just expectations of the sum of linear Gaussian random variables. So we can easily compute this first quantity. So we have the IRF of the Bayesian VAR, and now we can propagate them through the satellite, the latent systemic factor. Because we also estimated the latent systemic factor using a linear setting, we obtain easily this formula where the beta are the one from the linear regression, and this, S is the linear operator which allows us to only select the subset of variables that we used to explain Z. Because remember, for example, we did not take GPR, so we need a way to select only the variable of interest. So we have our two IREF, and now we can go to the PD responses. So why we rely on generalized IREF instead of classic IREF? It's because of this formula, which is nonlinear, and generalized IREF allows us to compute the IREF of the PD, and this is the closed form that we obtain. I will not go to the detail of this. I just wanted to show that we in fact obtain a closed form, and all of those quantities can be easily calculated, so we do not have to rely on Monte Carlo simulation, for example. Okay. Alors, so now to show a little empirical application of this methodology. We did an application in the United States. So we use macroeconomic and financial variables from United States, such as the GDP per capita, VIX, oil prices, real S&P 500, etc. There is also the Geopolitical Risk Index in the United States. And for the default rate, this is the IRB bank exposure in the United States. Okay, so this is a really high aggregated portfolio. So this is, as we can see, our design allows us to combine a long macro history, while the default rates are much shorter default panel. It's because we estimated the first block independently than the second block. Okay, so this is the GPR index that we already saw before. And this is the first result of the responses of the variable in the Bayesian VAR. First, as we can see, we did, as I said, we did one standard deviation shock of the innovation of the GPR. We can see that the VIX spikes on impact, the real equities falls a little bit, and log oil will first go up and start to decrease. This is not new. We saw a lot of those results in the literature, so I will go.
What do you call
real equities? S&P 500, so not corrected by. Okay, so and now we need to estimate the satellite model. So we took. So this is the 4 variables that explain the best the systemic factor. We fit the model on 37 quarterly observations. This is not a lot, but this is something that happens really often in the banking industry, that we not observe really long time series for the default rate, an R² of 0.71, and all coefficients here are significant at 1%. Okay, so now that we have our link between macro variables and the systemic factor, we can compute the IRF for this. So turn negative, but not instantly. It's a bit flat at the beginning and start to go negative, and the peak around the 5 or the 6 quarter. We have a lot of uncertainty, so I will just comment on the median. The uncertainty came from the Bayesian VAR, which was not, which we observe a lot of uncertainty on the IRF, but also with the fact that we have a really high aggregated portfolio. So we do not, I mean, it's hard to take strong conclusion on it, but I will only talk about the trend of the median here. The darker band, confidence band, are 68%, and the lighter one are the 90% band, confidence band. Okay, and now we can so go through the response of the PD. So here, this is the response of our portfolio PD. And as we can see, there is a delay first. The PD decrease and start with increase and to peak around the quarter 6 or 7 with about 14% more relative to the long-run average PD of our portfolio. But as I said, we have a lot of uncertainty. It's hard to take strong insight from this. Okay, when we are doing classic IRF, because everything is linear, there is not really a lot of interest to do a 1 standard deviation or 2 standard deviation shock, because everything is linear, the trend will not change. But here, because the Merton formula is nonlinear, as we can see here, we did a shock of 4, and the trend of the responses are not the same. Oops, sorry. So here we calibrate the shock to the 911, which was the higher, innovation shock into the series of the GPR. And we observe that we have an increase relative to the long-range PD of 81% around the quarter 7, but still with a lot of uncertainty here. Okay, 5. So we did some, robustness on the estimation of the satellite model. So we did this. I will not go into more details. So we also choose other VAR specification to see if we have, if it's robust. We saw approximately the same. This is the same amplitude of shock. It reacts, a bit faster here, but we still have first a decrease and an increase in the PDs, and still the same uncertainty. Here we do the same framework, but with another proxy of the probability of default. So we replace this really large IRB exposure in the United States by the US delinquency rate, but this is not the same definition of default. So we do not really take the same conclusion, but as we can see, it first go down, start to increase, and still a lot of uncertainty, but this is still a really aggregated proxy in the United States. So I think that to conclude, to stress this conclusion, there was I think it was this Monday, in the BA press release, where they say that during the last 2 years, the banking system seems to be resilient to the increase of the geopolitical concern. And as we can see, when we took a large aggregation of the IRB banks exposure in the United States, which is also not the country that was the most impacted by geopolitical risk, but the portfolio seems to be strong, that we have a lot of uncertainty. We are still close to 0 most of the times, and I think that that's consistent with the report from the EBA. So we developed a transparent Merton framework that allows to trace. As we can see, we have the war uncertainty propagation, which is not, which are not given by standard stress testing framework, and the approach combines endogenous macrofinancial scenarios generation and a structural macro to credit bridge, and also, as I said, the closed form PD responses. We know that regulators do not like Monte Carlo simulation, so we think that's an important thing to stress. That's it for me. Thank you everyone for your attention.
So thank you for the invitation. So, so these two papers, very complex with a lot of machinery on modeling. In the interest of time, I'll go a little bit faster. So the first paper, just to recall, it's a paper that models the contagion and vulnerability of mutual fund on the context of stress, and really the focus is on the style of the fund. Okay, so I will emphasize this. So in terms of methodology, as you have seen, it involves a lot of things. I will have some comments about these, but let's go here to my comments. So first comment is that this paper, it's about periods of stress, and it's important how you model risk. So they have tried to differentiate and give more heterogeneity to the assets that funds have, and have used the normal beta. So my suggestion is, why not using a measure that is more related with periods of downside of stress, like a measure of downside risk, to measure and quantify the risk of the assets. A second comment is, as I said, the focus of the paper is on the styles of the fund. So if it is a growth fund, a value fund, a large fund, small. And they present on the paper, that it's not on here today, but the correlation between these funds is very high, larger than 0.9. So it's not really, a big difference from there. So they present arguments that, the different results that they find is coming from, for instance, for the growth funds, is because they invest in high duration and high volatility stocks, but there is no evidence on that, so they don't present. So it just, it stays a little bit on the air, kind of speculation. Again, they argument that growth and growth income funds have more institutional investors who react faster to market-wide shocks, but again, there is no evidence. So I think, my suggestion is more to strengthen the paper and the arguments of the paper. Just don't leave things on the air, really present some evidence that justifies why you have these findings. Another thing, so in this model, they start by granular data, right? So they start with individual holdings of the funds. Also, but at a certain point for the contagion, they aggregate everything, okay? So I think this also should be better analyzed and should better be discussed on the paper, because sometimes you mix the interpretation at style level, individual level, and at aggregate level. So you should justify better what are the real effects when you aggregate everything and you lose the heterogeneity of the funds. Now, coming back to the heterogeneity of the funds, so the paper starts by the argument that treating all the funds as the same, this is misleading, okay? So that's why they go to disaggregate for the different styles of the fund. But I think there will be also more justification why going by the style, because in fact, in practice, funds also differentiate in many other ways, by the fund family, by the size, by the marketing intensity, by the distribution channel. So why just focus on the style of the fund? Which also leads me to another question is, so you start the paper by saying that this vulnerability of the mutual funds to the shocks, it's because of their style. And I recall that the style comes from the assets that they have, whether it is like, value stocks or growth stocks, large stocks or small stocks. But then all the discussion of the paper, why they have these resulting, is attributed to the clientele of the funds. So I think this mismatch between is it really the holdings, or is it really the clients, the investors of the funds that drive and these differentiate effects should be better addressed on the paper. And my suggestion is that, if you really want to focus on the type of assets, use variables like the mark-to-book ratio, or for instance, if you want to attribute and explain your results because of the clientele of the funds, for instance, why not focus on share class that are differentiated between retail and institutional investors. Another comment is that there is this strong assumption that flows react linearly to past performance, and this really clash with the empirical evidence that the relation is convex and not really linear. So it's something also that should be better justify why you take this assumption. So overall, as you have seen, this is a very complex modeling. The model tries to incorporate and differentiate many things, so it's very important contribution, so it really has many things. As I said, my idea, my suggestion was really to make the paper more sound and justify all the options, and in particular why you have these findings. Okay, so I have now the second paper. So this paper, I know it's very recent, as you have seen. Remember that it's about the effect of geopolitical risk shocks on bank probability defaults. I'll come here. So really the main contribution of the paper is really to improve the modeling. So there is quite advantage on this type of models that give they are more efficient in terms of estimation. So this is important. A first comment that I have is this, you use US data, but then probability defaults are from Europe. Banking systems in Europe and US are quite different, right? So I think at least this should be better justify why you pick US indicators to study defaults of European banks. Okay, so I think this makes because I think you address something on the robustness, and then you find very different results. The order of magnitude of results are different. So at least justify better why you go for these options. Again, another comment that I have is that there is the panel is short. This affects the stability of the results. So this is something that you also acknowledge, but might also influence the results. Okay, another comment that I have comes from one assumption that the model does, that there is a common asset correlation across. The value that you have, it's a little bit below what is typical. So I think this also needs a little bit better justify, because it's because the floor of Basel and even typical corporate portfolio value. So and this has some implications about the cross-sectional variation in the default. So this might lower the effects. What I think is missing in the paper, okay, you present a new paper, a new model, sorry, with new results, but then you don't benchmark against traditional models. So I think this should be also, to validate what if you have better results. I think this is really missing on the structure of your paper. And again, for robustness, there's not much discussion about anticipation. This is common in financial markets to anticipate events, right? So can be some, and there's not much. So I think for robustness, you also should address this. So thank you very much.
So thank you very much for your comments. So I tried to give some answers. I'm not sure that I remember all the comments, and I'm not sure that I totally understand on the suggestion. So the first point is about the use of the downside beta versus the standard beta, because we deal with negative shock. It can be a good direction that we will explore, because our we reason very simply is that the shock, we know that when a shock hit an asset, so how the asset responds to the shock is via its beta. So that's why we measure beta. And in this work, we have estimated more than 20,000 beta for 20,000 stocks. So maybe we'll try to see if we'll obtain something different. When it comes to our suggestion that maybe our result can be explained by the fact that growth-oriented funds have an investor base which is composed essentially of institutionals, so they react quickly when there's shock, while small cap and micro cap have more, can I say, individual investor. They are not as dynamic as the institutional one. Effectively, in our study, we didn't have the ability to do this work because it is a very big study already. But we complement our study by other empirical ones that investigated the behavior of institutional investors and individual investors during the COVID-19 with not only, I think which the study based on the US domestic equities too, so on the same sample as ours, but with data on their transaction, not the asset holdings. Yeah. So we took the graph for granted, and we try to explain our results by those obtained in previous study. Okay, so yeah, I'll try to bring my answer later. Thank you.
So thank you very much for your comments. I will address first the comments on the default rate data. So why we used IRB banks exposure in the United States. First, this is because we did not have data from bank in the United States, so we do not have access to their default rate, and also so we had the data from IB banks, and because the GPR is, I think, a better proxy for the tension concerned by the United States. That's why we took default rate into the United States. Also about the short default time series, I mean, as I said, this is common in the banking industry, so I think it's also realistic that what we can really observe in bank. And for the benchmark models, when you ask this question, it sounds obvious to do it, but didn't really think about that, so thank you for these comments. Thank you.